Hello again, everyone. It is 8 o'clock in the morning, Chicago time, on Monday, June 12th, 2023. I'm John Kosar from Asbury Research, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe are the most important to be aware of and potentially the most influential to U.S. stock market direction over the next several weeks to several months, potentially stretching into the latter part of this year. I typically produce a Your Daily 5 podcast once a month for StockCharts, but this is a rare occasion where I am doing one in back-to-back weeks. So I'm going to try to take advantage of the situation by showing you some of Asbury Research's additional investment models that we don't typically use in these podcasts just because we don't have the time, and also to elaborate a little bit on last week's podcast because we believe that this is a special strategic opportunity to participate in the U.S. stock market following 6 months of sideways trade. With all that out of the way, let's follow the money. Slide number 1, the S&P 500 at 43.25 could trigger a tactical correction, but above it, 46.37. So here's our chart of the S&P 500. It goes back to the very end of 2021 this is a chart, a daily chart, I should say, and it includes the 200 and the 50-day moving averages. The 200 is in orange here. That's the major trend proxy, and the 50-day is a minor trend proxy. That is in blue. This sideways rectangle here is what the meat grinder that the market has been in really for the past 6 months outside of the past week or so. When the market moves sideways like this, it indicates indecision. And that indecision, I think, stemmed from tried to break out above the 200-day moving average in the early to middle part of December, right here that I'm circling, failed. Came back down, set a low here on December the 22nd, broke through the 200-day into the beginning of February, but failed and fell back below the 200-day moving average again into the March lows, mid-March lows, and then throughout the month of May, we kept bumping our head up against 4,200. When the market doesn't know what to do, it goes sideways because it's safe to be inside of this box. Once you go outside of this box as an investor, that's where the risk is. So what happened is we had a breakout. The internals got better, and I'm going to show you that in just a moment. The internals got better, which facilitated the breakout that we had on June the 1st. Look where we went to on Friday. Just this past Friday, we stopped on a dime right at 43.25. That's the August 16th high from last year. Formidable resistance area, easy to see on the charts. If we break through 43.25, our next level is 46.37. Our next big level, 46.37. That's the February high from last year. If 43.25 holds as a resistance level and turns the market down, our support, primary tactical support is what we call it here at Asbury, is 4,200, again, the top of the rectangle, and also 41.52 coming up underneath it. That's the blue 50-day moving average. Note how the S&P 500 has been up above it since April and tested it 3 times, so the market sees it. So 4,200 to, let's call it 41.50, is the level that we would expect a pullback to happen if 43.25 holds as a resistance area. Number 2, the market internals. The Asbury 6 remains positive. The Asbury 6 is our own internal metric that measures the baseline health of the market on a daily basis, much like a doctor does when you go for your annual physical. He looks at you coming through the door, and he may make a visual assessment of if you look healthy or not. Then he puts you on his little bench and start checking blood pressure and pulse and listening to heart and lungs, checking your reflexes. Gets a much better, a lot more accurate, less superficial look at what your real internal health is. The reason that we built this indicator is because of the way the S&P 500 trades now. It might be up 50 today and up 60 tomorrow and lure you in. Maybe do a breakout. Maybe have a breakout through a moving average or a trend line and kind of suck you into the market. Then the next 2 days, it's down 80, it's down 70, and you're afraid it's a false breakout. You think you made a mistake. You're redrawing your trend lines. So you get out of the market, right? Because you make mistakes when you're emotional. Then from there, it turns right around again and goes higher. Looking at this Asbury 6, if this would have been green the entire way through that series of events, we would have held our long position. I've just found that it helps myself, it helps our subscribers to not get faked out by all of these moves. So right now, the signal is up. The signal is positive since May the 18th. Circling it here on the chart, we've gotten 3% of a rally there so far. As long as these 6 metrics stay green, or 4 of the 6, because it takes 4 to make a directional signal in the Asbury 6 itself. As long as 4 of these stay green, the likelihood of us breaking 43.25 and moving on to that next resistance level is very good. If we do not, if these start turning red, you start seeing one by one, they start turning red, that's going to tell me that 43.25 is holding back here, and we're likely to come down and revisit this 4,200 to 41.52 area again. So right now, Asbury 6 is positive. You can see they've been positive. These are all the dates. Asbury 6 started to go positive in the beginning of May, and the last 2 ticked to positive on June 1st and 2nd, just as the S&P 500 was breaking out of the rectangle. Number 3, sector rotation. The SEAF model, which you're going to look at in just a moment, currently favors XLY, XLK, XLI, and XLC, which is consumer discretionary, technology, industrials, and communication services. Here's our SEAF model. I built the SEAF model 5, 6, 7 years ago because the previous model that we used here at Asbury to do sector rotation, it wasn't fast enough. It wasn't agile enough. The sector rotation sped up. It used to be a sector rotation trend would last a quarter or 2. Now, if you're lucky, it's 6 or 8 weeks. So we needed a better way to be more agile. And what I did was, rather than following the relative performance, I started following the money that's moving around these 11 sector spiders. So I built an approach that does that, and then we built a ranking system that ranks them from 1 to 11. All of these 11 together are effectively the S&P 500. So I built an approach that ranks the best and fastest moving money going into that sector is rated number 1. The fastest money coming out is number 11. So over this past week, fastest money going in was industrials. The fastest money going out is technology, up here at number the 11. And then we did it in 3 different time frames. Trading, which is weekly, tactical, which is monthly, and strategic, which is quarterly. Now we add these scores up, and it's just like golf. The lowest scores mean in 3 different time frames, the ones that have the best scores in terms of speed of assets going into that particular sector. So and favored are scores of between 3 and 15. So right now there are 4 that are favored. Here's consumer discretionary with a score of 9, technology with a score of 13, and then industrials and communication services with scores of 14. These are the 4 that we are currently looking for opportunities in. And by the way, our SEAF model has been overweight technology and communication services for most of this year. Specifically, technology has been favored by SEAF for 15 of the past 18 weeks, beginning on February 6th, has outperformed the S&P 500 by 13% since then. As long as the money keeps going into these sectors, they keep outperforming. SEAF has also been overweight communication services for 9 of the past 10 weeks, beginning on March the 27th, and that sector has outperformed SPX by 4% since then. So, and finally, 3 of the 4 top SEAF model signals here, of these top 4 that we just discussed, 3 of them have been the best performers for the year. So the point is there's a direct relationship between asset flows and what happens in these sectors, and that's where we have been able to find some opportunities in the sector space this year, even though the S&P 500 was going sideways inside of the rectangle pattern. Number 4, global asset allocation. Watch Taiwan, Mexico, South Korea, and Brazil. So this is another model that we don't normally get to show for your daily 5. It's our US versus the world model. And what we're doing is we're measuring the relative performance of 24 foreign markets versus the S&P 500 in those three same time periods: trading, tactical, and strategic. You see trading in yellow, tactical in blue, strategic in red. And what this is showing is there are only 4 foreign markets that are outperforming the S&P 500 right now, and they happen to all be outperforming in all 3 time frames. Taiwan, here's Mexico, South Korea, and Brazil. That shows us where to look for opportunities overseas. Typically what happens when the S&P 500 is strong, as it's been for the past few weeks, you see all that performance going back to the U.S. Where this model is very valuable is when the U.S. is weak. A good example of this was last year. As our markets were weak, Western Europe started showing up as an overweight in September and October. We had Italy, France, Spain, and a few others that started outperforming. Through May of this year, those countries outperformed the S&P by 20%. So while the S&P was languishing either in a downtrend last year or languishing in a sideways pattern this year, this model showed us where we could temporarily maybe take money that we had going into the U.S. and put it offshore for a while and try to take advantage of another opportunity while the rectangle in the U.S. was sorting itself out. Finally, the bigger picture. Investor sentiment suggests more upside potential. And what we have here is the S&P 500 weekly going all the way back to 2010 up in the top panel. Down in the bottom panel, we have the investors' intelligence data. Percentage of bears. Asbury Research is actually an input into the investors' intelligence data. So, we study that data. I've been getting it for many years. Here's the message of this chart. A bearish extreme in this particular piece of the II data showed a bearish extreme on August 2010, October 2011, Feb of 2016, Dec of 2018, March of 2020, the COVID bottom. And then we've got 2 side-by-side bottoms in June and October of last year, which were the big bottoms of last year. That suggests that another similarly important bottom is in place in October. And the fact that this metric hasn't moved to most bullish extremes yet suggests that the move still has legs. So again, it's a little bit more abstract. It's a little bit more long-term looking. But this suggests to us that this move is not over at 43.25. It still has legs. I believe that when this thing is through, we could be back up at S&P 4,600 to 4,800. That's why I'm glad I had a chance to kind of talk to you in back-to-back weeks, because I think this is a special opportunity for the S&P 500. Finally, let me leave you with one last little interesting bit of information, something I wouldn't trade on, but within the context of this, I think it's worth a listen. Since 1957, the S&P 500 has ended the year in the red just 18 of 65 times, including 2022. On 14 of those occasions, the index returned to the green the very next year. And on average, the S&P 500 gained 15% in the years following a negative year. So there it is. These are my 5 most influential market metrics to watch according to Asbury Research's data-driven approach to stock market investing. I hope our approach to financial markets resonated with you today. If it did, I invite you to visit our website at asburyresearch.com to get more information about us and our data-driven trading and investment models. You can also get access to more free stuff, more free audio and video presentations like this one, including our Following the Money with Asbury Research podcast by subscribing to the Asbury Research YouTube channel. Thanks for watching. I'll see you again soon.